What are index funds and how do they work? For the majority of investors, being successful means outperforming the market itself. While many investors, especially newer ones, strive to make their portfolios outperform the market, it's not always the case, nor is it realistic. How do investors stay at least in line with the curve, if not ahead of it? This is where index funds come in. What are index funds? Index funds are a portfolio of stocks or bonds that impersonate the performance of a financial market index. They replicate a portion of the stock market, or, in some cases, the market itself. To understand this fully, let's first understand how an index works. An index is a way to track and analyze the performance of a certain group of securities or assets in the market. Indexes are used to measure data like inflation, interest rates, among others, and they're often used to establish benchmarks or standards of performance for the portion of the market being mimicked. Think of it as a small architecture scale model of a full-size building. This small-scale model is essentially the portion of the market that is being tracked, mimicking the original in proportions. For example, if an index fund is tracking the NSE Nifty index, this fund will have a total of 50 stocks in its portfolio, and each of these 50 stocks would be given a certain weightage by the stock market, replicating the proportions of the index. As such, the performance of the index fund would be based on the performance of the actual stocks in the market. Index funds are also known to be key when it comes to portfolio diversification, a strategy where you spread your investments across different types of assets and securities in order to balance out or mitigate the risk an investor takes on. When an investor purchases an index fund, they are exposed to many different kinds of stocks in the market. Types of index funds. Before we dive into which kind of investor/S must invest in index funds, let's skim through the different types of index funds. Broad market index funds. Broad market funds mimic a large section of the stock market. Index funds like this generally have the least expenditure while also being incredibly tax efficient, making them popular with investors who want a large variety of stocks and bonds. Market capitalization index funds. Market capitalization, market cap, is basically the market value of a company represented in a dollar amount. Market capitalization funds give weightage to different company stocks based on their market cap. As such, a larger portion of the fund is dedicated to large cap companies and a smaller portion to small cap companies. This allows investors with a long-time investment horizon to have higher exposure to small and mid-cap companies, allowing them to generate higher returns than other index funds. Though a great chunk of index funds are based on market cap, investing heavily in such funds can lead to compromising the diversification of your portfolio. International index funds. Essentially, global index funds are based on indexes that are not limited to any country or stock market, giving the investor exposure to international companies in emerging markets and more. Earnings-based index funds. These are index funds that are based on the profits generated by companies, and these are further broken down into two kinds of indices, growth and value. Growth indexes are made up of companies that will generate profits faster than others in the market, while value indexes contain stocks of companies that are trading at a lower cost compared to how much the company is earning. Bond-based index funds. These are index funds that invest solely in a combination of short, intermediate, and long-term bonds. Such a combination not only helps you diversify your investment portfolio, but also yields steady and healthy returns month on month. Investing in funds like this is popular amongst investors looking to generate a monthly income. Should you invest in index funds? Before you decide to invest in index funds, it is important to assess your risk appetite, your pre-decided investing strategies, and the duration of your investment. For those with low to medium risk appetite. If you're someone who has a small to medium risk appetite and would prefer playing it somewhat safe, then index funds are the right fit for you. For those who want to invest in the stock market passively, since index funds reflect a section of the stock market or the market itself, the returns from these funds basically match the market's performance. They are passively managed by fund managers rather than the investment being strategically and actively managed by a manager to bring in higher returns. As a result, they consist of lower expenses and fees when compared to actively managed funds, and hence are a great option for new investors.